Hey everyone, welcome back to Accounting with Kamo. Today's video is all about something that appears in every test and exam, the income statement. I'm going to break it down step by step so it's easy to understand, whether you're in grade 12 or first year or a first year student in university. Right. So let's get into it. As you can see with the title, it says how to prepare an income statement. All right, so this is a step by step guide whereby I'm going to show you how to actually prepare an income statement. Now, what is the purpose of an income statement? Right, the purpose of an income statement is that the income statement is a financial report that actually shows what it shows the income that was earned during the financial year. So obviously it needs to show us the money that a business has made in a certain year, and it also now shows us the expenses that incurred during the same period. So the same time a business has income, it's the same way that they're going to have expenses, obviously, right? So that's the second thing that a income statement will report to us, right? Then last but not least, we literally will have either the net profit or the loss of the business, right? And this one is just a note right there. Sometimes they might ask for the theory right there at the end, but it definitely helps owners and investors to definitely see if the business is performing well. Remember that people, owners and investors are people that want to keep inputting their money into the business. So they need to know if they have to invest more or if they have to stop investing or if they need to look at other businesses. So an income statement literally helps them decide whether they need to invest more or just to invest less or move into a different business. Then now, I want us to look now at the standard format, the exam layout, right? So remember that the layout in of how you literally write your stuff is very important when it comes to accounting. So the first thing that we have is that we have the sales and revenue, right? Sales and revenue. So at university, they basically call it the revenue, but in grade 12, we'll just stick to sales, right? So that's just sales. So as you can see with the example items, it's just sales. So sales is basically the money that we made from our services or actually from selling the stuff that we are actually by selling our products that we sell as a company, right? Then after that, what do we do? You are going to less. By less, we mean you have to subtract the cost of sales, right? You have to subtract the cost of sales from the sales, right? So how do you get the cost of sales? Sometimes the cost of sales is given to you. So meaning that you are given the amount of cost of sales or of how much cost of sales were. But sometimes they might give you the opening inventory, the purchases, and the closing stock. And how you calculate it is that you definitely are going to have your opening inventory, then you're gonna add your purchases, then you're gonna subtract your closing stock. Right. So remember your opening inventory is literally the inventory from the last year or from the last month. But since we're dealing with an income statement, it's definitely going to be the inventory, the closing stock from the last year. Then purchases is definitely the stock that we bought during the year, and the closing stock is the stock that we have at the end of the year in the business, right? And now when you say sales subtracted by cost of sales, we're gonna get something that we call the gross profit. With the gross profit now, that's just the profit before any income, before any expenses, before tax, before any interest can occur or in the business, right? So now let's move on. What do we have next? After that, we are going to add other income. So with other income, your other income now, obviously, you have to add your income to your profit, right? Your things like your rent income, your interest received, your commission, right? Depends on which type of income that you might be dealing with. But the for just a few examples there, we have rent income, interest received, and commission, right? Then obviously the gross profit added by the other income obviously is going to obviously give us our total income. Then now, after getting our total income right there, we are going to subtract it by what? We're going to subtract it by our operating expenses. Now, what do we have as our operating expenses? For operating expenses, we have what? We have salaries, wages, your rent expense, your water and electricity, and many more, right? So remember, your operating expenses are just the expenses that a company will have in that year specifically, right? Then, after subtracting your operating expenses from your total income, you definitely are going to get your operating profit, right? Operating profit. But obviously, you do know that now after that we have to subtract our finance costs. So what is our finance cost? Our finance cost is literally the interest on loans, right? So remember that there are companies that literally start off their businesses on loans, or they literally take loans during the year. So with those loans they literally have interest that the company has to pay each and every year or each and every month. And those loan though that interest that they pay back on loan is what we call our finance cost, and it needs to be subtracted from the operating profit. So do not make the mistake of actually adding the finance cost or the interest on loan on the operating expenses. So don't let interest on loans be part of the operating expenses right there. I hope that makes sense, right? And obviously, after subtracting your finance cost, you're gonna have what you call your net profit or loss before tax. Before tax. All right. So definitely we're gonna have it before tax. Then after that, obviously, we have to subtract our tax. And obviously, tax is literally tax that is charged to the business. Sometimes they're gonna tell you that the tax is going to be 15% of the net profit or the loss, or it's going to be 5 or 15 or whatsoever of the net profit or loss. So sometimes they can just tell you the amount that the tax for the year was 100,000 rands. Then you're just going to subtract it from the net profit before tax. Then obviously after subtracting now your tax right there, you now are going to have your net profit or loss after tax, and that is definitely our final result of the income statement, right? So you need to actually know this by heart. You need to know this whole part by heart. You need to know that you start with your sales, then you subtract your cost of sales, then you're going to get your gross profit. After your gross profit, you add your income, your other types of incomes, then you're going to get your total income. Then you subtract your other expenses, you get your operating profit. Then after your operating profit, you subtract finance cost, which is your interest on loans. Then after that, you get your net profit before tax. Then after that, you need to subtract tax. Then after subtracting your tax, you're going to have your net profit or loss after tax. So make sure that you know this format, because it is very, very important that you know it. Sometimes, or most of the time, they're going to give you a blank answer sheet and you have to fill in each and everything, right? Now, let's actually have an example breakdown of key items now. All right. So now with key items, what is it that we have? Remember here I said it's either called revenue or sales, right? So just remember revenue, it's a word that they mostly use in university, but sales, it's the one that they use basically in grade 12 and 11 or 10, right? So you're gonna use sales, but in university they call it revenue, because revenue and sales are basically the same thing, because it's just the money that we have made as a business, right? And your revenue or your sales are literally just your total sales or services that were rendered before any deductions, right? Before any deductions. Then now your cost of sales, like I have explained, is that you're going to have your operating inventory plus your purchases minus your closing inventory, right? And that will give you the cost of sales for that specific year. Then now with operating expenses, we have your rent expense. Remember, as a business, if we were to rent out an office or we rent out a warehouse, we have to pay rent for it. And that's since we're paying uh parking rent for that place, we definitely are going to call it rent expense. Your salaries and wages, those ones are definitely an operating expense, because money is leaving the business. We are paying our workers for working for us, basically. We are paying them for working for us. So we literally have your salaries and wages. And make sure, guys, never mix up your salaries and wages. Salaries and wages, sometimes they give you, like, they say salaries and wages and they give you one amount. Sometimes they just say salaries, then they have another column for wages. So make sure that if they do that, just put them in separate columns. But if they give you in one go, like salaries and wages, then you must write them in just one single go, right? Um, then after that we have depreciation. I have covered depreciation. I have a video on depreciation that is already up. So if you haven't looked at it, go and check it out. I think it's the second video in the channel if I'm not mistaken. I'll put it also in the description below so that you can also check it out. So we have depreciation. So in short, depreciation, it's just the cost that it's just the a vehicle or equipment losing value in time as you get it, as you use it, right? Remember that when you use an item, it's literally going to lose its value. So that is basically what we call depreciation, right? But if you need more information on it, go check out that video, right? So then now we have your telephone. Telephone, obviously, things like your airtime is literally under your telephone, right? Then after that, we have stationery. Stationery, most of the time, we know that companies, obviously, or businesses, they'll need books, they'll need pens, they'll need glue, scissors, things like that. And that is also an operating expense because they need to pay for those stuff. Then we also have advertising. Remember, with advertising, people need to see what the business is selling. And for us to advertise, we need to um pay, obviously, broadcasting people, right, to for it to be shown on TV. We need to pay people on YouTube if they want to advertise it for us on YouTube, since in these modern days now people advertise their stuff on TikTok, YouTube, and all, and Facebook and all that, right? And we also have the biggest one, which is insurance. Insurance, obviously, for a company, it's very needed because you need to have insurance for your company just in case of damages that you might incur in the business, right? So you need to definitely have insurance. So insurance is one of the operating expenses that you might have. And then now, on that, we also have other income. So with other income, obviously we have rent income. So now with rent income, remember we have rent expense and rent income. Remember that there's a difference between the two. There's rent expense and rent income. So with rent income, that is when now we have a place that we own a place, but that place we do not use it. So instead of not of just letting it be there and not work or never have a use, we literally say, well, you know what, we can rent it out for this certain amount, and when somebody rents it out, they're going to pay us a certain amount, and that right there, we call it a rent income. Then also we have something we call discount received. So a discount received, we also view it as an income. Why do we see it as an income? Somebody might be asking themselves. A discount received is basically when let me just say you want to buy a cell phone, rather, which is 10,000 rands. So if a cell phone is 10,000 rands and you are anticipating on paying 10,000 rands, the moment they give you a discount for 2,000 rand, remember that now you no longer buy that phone for how much? You no longer buy that phone for 10,000, but you're going to buy it for 8,000, since they gave you a discount of 2,000. And that 2,000 is definitely going to go in your other income, because now that discount allowed you to pay for a less amount, for a lesser value, right? So that way, that money, you have saved it basically. So we see it as an income. Then also we have interest received. I have explained interest received in one of my videos, but in short, interest received is just the interest, or like it's just the money that we receive for just having a positive amount in our banks, right? Then or if maybe we have invested, so when we invested, our investment gains interest, then we literally receive that interest. That's what we call interest received, and that's why we put it as an income. Then also we have commission received. So commission, remember, when you work, you get a certain pay. So when you work and get a certain pay for that type of work that you did, sometimes it's called commission. And obviously, since money is coming to us, we literally call it an income. Right. I hope those um key items made sense right there. So make sure that you know these things by heart, guys, because it is really, really needed. And the other one that I forgot, I'm just gonna put on the top right corner, is something that we call I forgot to edit the finance cost. Your finance cost. I didn't mention that your finance cost is just your interest on loans, right? So remember, your interest on loan, as you have obviously made a loan, you need to pay back interest of that loan each and every month or each and every year. And that interest that you pay back is definitely your finance costs, right? So make sure that you remember that. Then now we definitely go into one of the common adjustments, right? So I want us to literally remember, as I always said in my videos, that when you're dealing with an accounting chapter that has to do with the recording stuff, we need to also look at the adjustments that they might give you, because remember that you won't go anywhere without understanding the adjustments that they give you. Imagine now you get a question whereby the adjustments, you don't know what they mean to you. You don't know accrued expenses, you don't know prepaid expenses, you don't know bad debts, you don't know provision for bad debts. So that way, I wanted to look at it so that when you find it in your exam or in your test, you know how to go through it and you understand each and everything that they might ask you about it, and you know how to record them. Right. So, without wasting any time, we're gonna look at the first one. What is the first one? The first one is definitely what? It is definitely your accrued expense. It is definitely your accrued expense. So, what is an accrued expense? Accrued expense is literally an expense that is still owing. So let me just say, obviously, in a year, there's 12 months, right? We need to pay rent um, for 12 months. We need to pay rent 12 times in a year. But now, this time around, instead of paying for 12, we paid for 10 months, right? We paid for 10 months. So since we paid for 10 months now, it means that the 2 months are what we call the accrued expense, because that 2 months we haven't paid for it. So that payment that we still haven't made is what we call an accrued expense. Then now the effect on the income statement is that you are going to add to the specific expense. So remember, if you have an adjustment of rent, you're gonna have obviously an amount of rent obviously in your trial balance before you can actually start writing your income statement. They're gonna give you an amount. So on that amount, you're gonna add in your expense, in your rent expense, that you're gonna add the rent for the 2 months that you're still owing, right? I hope that makes sense right there. And then the second part, we have a prepaid expense. So it even says it in itself, prepaid. We have paid um for something in advance. So for example here, for insurance paid in advance. So obviously remember, in a year we have 12 months, so we need to make 12 payments. So instead, in the company they made maybe 14 or 13 payments, that extra payment or that extra month that they made of a payment, that's what we call a prepaid expense, because they have paid for more. So that money needs to come back to us, right? And what are we going to do in the income statement? We are going to subtract from that specific expense. So meaning that, for example, if we used insurance right here, right, for insurance, we were going to take the amount for insurance in the trial balance, then subtract the prepaid insurance amount that we paid for, right? So just keep that in mind. Then we also have now the income received in advance. Income received in advance. So if you have received your income in advance, right? For example, if you have rent for next year already received, and we already doing a trial balance for this year, but you've already received the rent for next year. When you're doing an income statement for this year, you need to exclude that amount for the next year, because it shouldn't be part of the rent income, right? Because we're only dealing with income for this year, not for the next year. So what is it that we're going to do in the income statement? We are definitely going to subtract from the income line. So meaning that we are going to subtract that amount from our rent income, because we have more rent income that we are supposed to have, right? So if our rent income was 12,000, and that person paid maybe 2,000 extra, which that 2,000 was supposed to be for the next year, we are supposed to subtract that 2,000. Then the rent income for that specific year in our income statement will be 10,000 rands. All right. Then now, next one, we have our income accrued. Income accrued, right? So income accrued, obviously, it is what is owed to the business. It is owing to the business. So this one, it is for example, it is interest that is still to be received, right? So this is just the money that we are going to receive. We haven't received it yet. So in the income statement, what are we going to do? We are going to add to the income line. So meaning that, since we are dealing with interest that still, for example, if we are still dealing with interest that still has to be received in our income statement, in our interest received, we are going to add that amount that still is coming to our business. All right. Then now, the next one, we have depreciation. Depreciation, I need you to actually understand this. Depreciation will always be an expense. Ain't no way on earth our depreciation will be an income. There is no way depreciation will ever be an income. Depreciation is always an expense, right? Because it literally decreases a value of an equipment, a vehicle, or a vehicle, right? So obviously, for example, on equipment or vehicles, right, we are going to add under operating expenses, like I mentioned, under operating expenses as depreciation. Remember, I have a video on depreciation. If you want to check that out, I'll put in the description below, then you can go and check it out, right? So, yeah. Then now, the next one that follows, we have bad debts. So from the word you can hear it, it's bad debt. So meaning that is when people have not paid back the money that they owe us, right? So remember that as a business or as a company, sometimes we are going to sell stuff um we are going to sell stuff to people on credit. So meaning that people are gonna take these items now, but they're gonna pay them at a later stage, right? But sometimes people don't pay back that amount, right, in time, or they just no don't pay back at all. So now when it's bad debt, it means that they have not paid back in time, or they have not paid back at all, or they will never pay that amount back. So for example, we have written off amounts, so meaning that we know that that person is never gonna pay us. So what are you gonna do with that amount? We are going to add it under operating expense because we have lost the money. Remember, when that person didn't pay us, but they already took the stock, that's an expense because stock has left our business. So that is definitely an expense. So we're gonna write it in our operating expenses as bad debts. All right. Then the next one now we have an increase in provision for bad debts. So there's two types of provision for bad debts. There's an increase and there's also a decrease. So we're gonna look at both the types of them. So the increase in provision for bad debts, right? For example, that is when now we have additional doubtful debt. So let me actually explain what provision for bad debts is. So it's that thing of actually saying that since we know that bad debts are when people that are never gonna pay us back. A company sometimes they literally have a provision for bad debts. So sometimes they'll literally sit down and be like, okay, we have sold our items on credit. So meaning that we gave our stock to other people on credit and they're gonna pay us back. But now we do not believe that everybody is going to pay us back. So since not everybody is going to pay us back, we need to have an account for provision for bad debt. So meaning that there are people that we think might not pay us back. So let's just say the things that were bought for credit in our company amounted to 20,000 rands, right? For to 20,000 rand. Then we say from that 20,000 rand we believe that 5,000 rand, so it's us making an estimate. So that estimate is what we call provision for bad debts. So we say that that 5,000, we believe that it might not be paid back to us, right? So that's what we call provision for bad debts. We are actually doubting people that are our debtors in a way, right? People that owe us, right? We are saying that in that 20,000 we might only receive 15,000, but not that 5,000. And that 5,000 right there is provision for betters because we think we might not receive it. So that is the reason why it is called provision for bad debts. So I hope that makes sense right there. So now, if there's an increase, obviously, in provision for bad debts. So obviously, if maybe our provision for bad debts was 5,000 rands, like I said in that example, then 1 month later we increase it and we say, you know what? I don't think we're gonna get the five, but I think we're not gonna get 8,000 rands. So obviously, if we increase our provision for bad debt, it means that now our expenses are going to increase. As you can see here now, on our effect on income statement here, we have what? It is what you are going to add as an expense under operating expenses because now we are anticipating that we're not going to get 3,000 rands more, right? Because now we are saying that we're not going to receive 8,000, right? So that's what happens. So same thing happens, but vice versa with the decrease in provision for bad debts is that now we are going to record it as an income because if we didn't think if we thought we were going to not get 5,000 rand and now we after a month we're like, oh, from that 5,000 rand we're not gonna receive. I think we're not gonna receive 3,000 rand. So that 2,000 rands that literally decreased the provision for bad debts, it literally comes becomes an income because now that money is coming to us, right? So I hope that the provision for bad debts there makes sense. So, but if you have a question on it, just drop um a comment in the comment section down below. Then maybe I can make a video specifically for it alone, right? Then We also have trading stock deficit or surplus, right? So remember these two things here. There's a deficit and a surplus. Remember, a deficit is a loss, a surplus is a profit, right? So for example, with the trading stock, obviously trading stock deficit or surplus, we definitely are going to compare the physical stock and the books, right? So let me explain this one, right? Trading stock deficit or surplus. Let me explain this. Sometimes in a company, we might have that we might find out that, hey, you know what? Our stock in the company, we have stock that amounts to 100,000 rands, but in our books, we have stock that literally amounts to 150,000 rands. So meaning that there is more stock in our books than stock in our in our warehouse or in our company, right? So obviously here we are going to add the deficit to cost of sales. So by the deficit, what do we mean? By deficit, it means that the physical stock that we have, um the physical stock that we have in the company now, it's literally less than the stock that we have in our books. So that is what we call a deficit to cost of sales, and that happens when they might have the workers might have stolen the money, whereby there were damages and they were not recorded, and that's when now we're going to have a deficit of cost of sales. Then with the surplus now, it is when now there is more stock in our company than there is in our books. Then that is when we have a surplus, right? So I hope that makes sense. Then with drawings now definitely it is literally stock taken by the owner. And this one we literally are going to reduce purchases. And this one is not recorded as an expense. Remember, I'm going to read that again. This one is not recorded as an expense. So what we definitely do, remember what I said. I said when you calculate your cost of sales, I said you do what? Opening stock plus purchases. So that drawings or that stock that was taken by the owner, you are going to reduce it from that purchases. You're not gonna add it on your expenses. No, no, no. It's not part of your expenses as a company, right? So I'm just gonna just unzoom here because I think we have more. So I hope that you can see. I'll just try to zoom in. Let me just zoom in there. No, that's too much. No, 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 no. My bad. Sorry, guys. Sorry. Sorry. I'm just trying to see these last two. Yes. So now, after our inventory, we basically are going to have our consumable stores on hands. So this is basically your leftover items like your stationery. All right. So sometimes you might have stationery that's left over in your company, and obviously you're going to subtract it from your expenses because remember that if now we have more Vulcan stationery that's left in our company, we are going to subtract it from an expense because it's still there. So meaning that we haven't used all of it basically, right? So that is what we call consumable stores on hand. Are just they are just things that literally got left behind and were not fully used in the company, right? Like your stationery. Maybe we bought 10 pens, but we only used two, so that eight will literally we will literally subtract it from our expenses, right? Then the last one we literally have our interest on loan, and it is accrued. Interest on loan, it is accrued. So meaning that now, barking, it is not yet paid interest. So meaning that we have not yet paid our interest. And if we have not yet paid our interest, we are going to add it to finance cost. Remember the finance cost, it's the one that we literally subtract before what? We subtract it before we can get the net profit before tax, right? So make sure that you understand these adjustments because they'll literally show them most of the time in your exam, right? So I hope that makes sense. So now I'm going to give you tips on for your exams. So with the tips for your exams, the first thing that you're going to do is that you need to show calculations. Remember that sometimes there are amounts that you need to add from the amounts that you get from your trial balance. For your rent income, your accrued expenses or your accrued income, you need to also show working on it. Your things like your depreciation, you need to show workings for them, right? So make sure that you never forget to do that. Then second one, I'd like to actually remind you of this one. This one is a very important tip. You need to watch out for adjustments. and make sure that you highlight them because they are very important. Sometimes your books do not balance because you haven't recorded all of your adjustments. So if you make sure that you record all of your adjustments, then maybe at the end your books shall balance. Then third one is that you need to keep your layout neat. The person who's marking your paper needs to see the amounts that you put there. Imagine now the teacher has to guess if you wrote a 6 or an 8, or if you wrote a 2 or a 5, and they literally can't see. So make sure that your layout is neat and make sure that your income is before your expenses. You put your text wherever they are and you follow the way your income statement is. You don't want to mix things up, right? Because it is very important that you write things in a correct order. Then now, with this one now you're going to what? You're going to have to use the correct titles and formats. This one is also very important. For example, in the brackets I said the income statement for the year ended. Dates in accounting are very important, guys. Dates in accounting are very important. So remember that when you're going to write the income statement for the year ended in June 2024 whatsoever, you need to be precise on when it did end because that is a very, very important information right there. So dates are also very important. Your titles and formats, right? So make sure that you remember that. And last but not least, this is a quick summary on everything that we did in the slideshow. So obviously, we have what now? The income statement. It does what? It shows us the profit or loss that the company has earned or lost in that specific year. All right. So that income statement, it includes what? It includes our sales, sorry, our cost of sales, our expenses, and our adjustments. I forgot to add here that it also includes our income. It also includes our income. Then the third one, I would like to say that understanding adjustments is key to getting full marks, guys. Remember that if you understand your adjustments, you literally are going to be able to record things in the correct places. Because sometimes we do not get full marks because we record our adjustments in wrong places. So make sure that you remember that. Then the last one, like I said, format, accuracy, and presentation are essential. Your dates, your adjustments, your calculations need to be precise, guys, for it to work out for you, right? So that's basically my like the tips that I can give you and the quick summary that I can give you. But yeah, guys, that's it for today's lesson on the income statement. I hope this helped you understand it clearly. If you found this video useful, please give it a like, subscribe to the channel, and let me know in the comments if there's a topic you want me to explain next. Thank you for watching, and good luck with your accounting journey.